Why UK mortgage rates may fall in 2026. That's the headline. That's the promise. And on paper, it sounds like good news. Rates easing. Payments softening. Pressure lifting. But here's the bit most people miss. When mortgage rates fall, they don't fall evenly. They don't reach everyone at the same time. And for some households, they don't help at all. This isn't a crash story. It's not panic. It's not doom. It's a story about quiet pressure. About people waiting for relief and finding out it's selective. Because in 2026, the UK housing market isn't about prices jumping or collapsing. It's about who gets access to cheaper money, and who doesn't. And once you understand that, the whole system starts to look different. Let's start with the obvious bit. The Bank of England has already cut the base rate to 3.75%. Not unanimously. A tight vote. 5-4. That split matters, mate. Because it tells us even policymakers aren't fully convinced the danger's past. Still, markets reacted. Lenders reacted. Mortgage rates, slowly, started drifting down. But here's where people get caught out. The base rate is not your mortgage rate. It's a reference point. A signal. A nudge. Fixed-rate mortgages don't follow it directly. A 2-year fix is priced on what lenders think rates will average over the next 2 years. A 5-year fix looks even further ahead. And lenders don't just price interest. They price risk. Risk that inflation kicks back up. Risk that jobs wobble. Risk that house prices stop behaving. So when the base rate drops by a quarter point, your mortgage deal doesn't magically do the same. Sometimes it barely moves. Sometimes it moves for some borrowers, not others. And that's when people start saying, hang on, rates are falling, why am I still paying through the nose? That question sits at the heart of 2026. Here's the thing. 2026 isn't just another year in the housing cycle. It's a reset year. Millions of UK homeowners are coming off fixed deals that were locked in when money was dirt cheap. 1%, 1.5%, 2%. At the time, that felt normal. Now it feels unreal. Those deals are ending, not all at once, but steadily. Month after month. And when they end, people don't fall off a cliff. They slide into a new reality. UK Finance expects refinancing activity to stay high through 2026. Not because people are excited, but because they don't have a choice. And the Bank of England's own data shows it. Approvals for buying homes have softened. But remortgaging approvals have picked up. That tells you everything. People aren't rushing to move. They're trying to survive the switch. Because when a fixed deal ends, the alternative is the lender's standard variable rate. And that jump can be brutal. So homeowners lock in new deals early. Even if the rate isn't great. Even if they think it might drop later. Certainty becomes more important than savings. And that changes behavior across the whole market. People delay moving. They stay put. They cancel plans. The housing market doesn't freeze overnight. It stiffens. Quietly. Now we get to the part nobody likes talking about. Affordability checks. You can scroll through mortgage deals all day. But you still have to pass the test. Lenders don't ask, can you afford this right now? They ask, could you afford it if things go pear-shaped? If rates rise again? If bills jump? If life throws a spanner in the works? Even as rates fall, those checks remain. And this is where a lot of people get stuck. Because falling rates don't mean relaxed rules. The FCA has made it clear that the mortgage market needs to be safer, not faster. That's good for stability. But it means access stays tight. So lenders compete for safe borrowers. Strong income. Plenty of equity. Stable job. If that's you, the market smiles at you. If it's not, you might be paying more, even while rates are coming down. That's the uncomfortable truth. Relief is real. But it's selective. And for households already stretched, that selectivity feels personal. Let's talk about recent buyers. People who stretched to get on the ladder. People who bought near the top of the market. People with small deposits. High loan-to-value mortgages are fragile by design. When prices rise, no one worries. When prices stall, risk quietly builds. Because equity is a buffer. It gives you options. It gives lenders confidence. Without it, choices shrink fast. If prices drift sideways or edge down, some homeowners find themselves boxed in. Not negative equity yet, but close enough to feel trapped. Rates falling helps monthly payments. But it doesn't rebuild equity. So these households live in a narrow corridor. They can't easily remortgage onto the best deals. They can't easily move. They're sensitive to every change in criteria. This is where pressure concentrates. Not loudly, not dramatically, but persistently. And persistent pressure wears people down. Between mortgage rates and rents. Between tax policy and household budgets. When rates rise, yields get squeezed. When refinancing costs jump, margins vanish. Some landlords absorb it. Some pass it on. Some exit. In early 2026, lenders are still repricing buy-to-let and residential deals. That tells us something important. The market is adjusting, but it's not relaxing. Landlord exits don't make noise. They happen quietly. One property sold. One decision at a time. But each exit tightens supply. And tighter supply feeds straight into rents. So even as mortgage rates drift lower, many renters don't feel relief. In some areas, pressure actually increases. That's the sideways effect of stress. It doesn't disappear. It moves. Now let's talk about sentiment. Not data. Not forecasts. Just mood. On housing forums, the same questions keep popping up. Should I fix for 2 years or 5? Should I wait? What if I lock in and rates drop again? People are rate shopping. Comparing quotes. Running the numbers again and again. This isn't optimism. It's hesitation. People don't trust stability anymore. They've learned that decisions can be punished later. So they sit on their hands. And housing markets hate hesitation. Because they rely on confidence. When confidence dips, activity slows. Not overnight. But enough. Enough to stall momentum. Enough to make silence. And silence is dangerous in a credit-driven system. Let's be clear. This is not 2008. There's no global banking freeze. No toxic lending explosion. Underwriting is stronger. Regulation is tighter. UK finance expects arrears to remain manageable under its base case. But the mechanism rhymes. Back then, confidence cracked before prices collapsed. Credit tightened quietly. Transactions slowed. Then prices followed. Housing markets don't snap. They stiffen. They seize up. And once that happens, recovery is slow, even with rate cuts. So falling rates help. But they don't erase the damage done during the high rate period. They buy time. Nothing more. Let's get this straight. Lower rates help. They reduce payment pressure. They prevent worse outcomes. They stop things spiraling. But they don't fix everything. They don't rebuild lost equity. They don't loosen affordability rules overnight. They don't restore confidence instantly. Real recovery needs 3 things. Stable jobs. Predictable credit rules. And belief that today's decision won't backfire tomorrow. Until then, falling rates are a cushion, not a cure. So yes, UK mortgage rates may fall in 2026. That's the direction of travel. But the real story isn't just about rates coming down. It's about who benefits. Some households will feel relief. Others will feel very little. And some will feel none at all. This isn't a collapse. It's not a recovery either. It's a housing system under quiet strain. A system where access matters more than headlines. If you're in the UK, your experience matters. Are you remortgaging this year? Are you waiting for better deals? Or are affordability checks still the biggest barrier? Subscribe for calm, evidence-based breakdowns of what's happening under the surface of the UK housing market. Because this story isn't finished. But the rules have already changed.